Hello, Jens. Good afternoon.
Hello, Theo. How are you?
I'm very good. How are you?
Well, weekend.
Okay. So
And
interesting.
it's longer than usual, no? So we have Labor Day on Monday, so no US equities trading, if I'm not mistaken.
Yeah. I was just looking now the outcome of the non-farm payroll, and of course, as usual, the actual never confirmed the forecast. Never, of course, especially when the ADP shows a different number. The non-farm payroll, it's going to go the totally opposite. So, yeah.
Let's see. Let's see how this plays out. So I think action wise, not really sure what to make out of it. It's, to be honest, so in terms of equities, like if it's bullish or bearish, like bad news is good news. But what I think is interesting is how gold performs now. If gold is capable of breaking above what is it, 1,950 or so.
Yeah,
If we
yeah.
can hold above that level, I think that's going to be interesting. Because the thing is, with Labor Day on Monday, do we get really like sustainable moves? I'm not really sure. So like, could you imagine that's kind of a fake out, and then we are just drifting out and then probably get fresh impulses, let's say next week on Tuesday or so.
Yeah, makes sense. I'm also watching the WTI chart. I mean, it's been a while. I was hoping for some deep corrections, to be honest, below the 77 level, but hardly. Now it's time to break above the recent resistance at 84.60. So.
And in addition to that, I think that's very interesting. We know that inflation came down due to WTI energy prices dropping, no? And now we have like, well, is it really such a strong employment situation? Can the Fed really hike further? Well, we don't really know. Cutting rates. Well, can the Fed cut rates if we are running into higher inflation now, or potentially higher? Let's see that. I think that's like.
Yeah.
I'm not really sure. I think this is stagflation, if you ask me.
And with China and with the real estate, we'll see what's going on.
China has a deflationary environment, right? So right now, so latest numbers were below zero, I think, minus 0.3 or something. And we talk and talk. Shall I share my screen, Theo?
I think so, yes.
Probably. Well, it's not that I have the charts here, but we will look into the charts in a few minutes.
Awesome.
Let me just, by the way, type in here, hello traders.
I wish you best luck. Enjoy the long weekend. I'll talk to you next week.
I have a family. I have a wife. What shall I say? No work.
Awesome.
Okay, so
alrighty. Enjoy the webinar.
Thanks, Theo. Have a nice weekend. Talk to you next week.
Thank you.
So, yeah, hello and good afternoon. I welcome you to today's Trading Spotlight webinar. Let's trade the non-farm payrolls. So I think, well, we covered already a bit with Theo a few seconds ago. I think it's a very interesting situation right now. I'm heading into. I think the interesting thing will be to see if, as I already mentioned, gold will break sustainably higher. It's not that often, but today is one of these days where I haven't prepared anything in terms of my US equities trading. So usually you probably recall me saying something like 5 minutes, 20 minutes around into the webinar. I say, well, 1 minute, please. And I will update my sheet here, my Excel file for having details available for my trading journal, then for my live trading. So for my US equities trading. Today, I haven't prepared anything. I haven't, in fact, prepared anything. Somehow, I think the main move this week was with was Tuesday, I think, this bull run on the upside. And we saw a continuation on the upside, especially in the NASDAQ in this case. And then we stalled out. That was yesterday. And today, I'm not really sure whether we will continue higher. Probably we will get some erratic price action around the market opening. But then I think chances are not that high that we run, let's say. I mean, we have some title stocks which could be in play today, like Dell, for example, or MongoDB. It's MDB, it's the ticker symbol. Probably Lulu. All of them reported earnings yesterday. But I mean, Dell is not the most active stock, even though gapping currently up 12.5% or something, and seeing also elevated volume in the pre-market. But I'm not really sure whether we really have a chance, especially with the Labor Day weekend ahead. Most likely, we should focus really on macro plays today, and that's why I think gold, especially, is interesting with running up to and currently breaking to new weekly highs above 1,950. The question is, and this is a problem. In the morning, I was talking to a client who asked me, "Hey Jens, what do you think?" I told him I would probably keep an eye on gold, but I'm not really sure whether we get to see a sustainable break higher. I don't want to trade the direct break with a buy stop higher, but well, now let's see whether we can continue trending from here. So gold most recently with a bounce against 1,900, and I continue to talk. So you can already see we will have a look at the charts before. First of all, I want to make sure that all of us are aware of the risks involved when trading leverage products, especially CFDs, and that you please read carefully the risk disclaimer. If I, well, let's say give a game plan or share my view on the market and share with you how I would trade this and that asset, then please understand that this is not a financial advice, not even close. It's purely informational content, purely educational content. You can ask all your questions. For those watching now the recording on YouTube, please feel free to subscribe to the YouTube channel, leave a thumb up here if you like what you will see, and also please leave a comment in the chat box in the form of a question of content I provide or assets you want to be covered, and I will answer them. But again, please don't misunderstand this as financial advice. It's not. It's purely educational, purely informational. All risks, especially the risk disclaimer, can be found on the website. So about Admirals, FX and CFD broker within this industry now for, I think, over 20 years. If I'm not mistaken, SISEC regulated, FCA regulated, ASIC regulated, so fully regulated broker with a very competitive offering when it comes to FX, but also when it comes, for example, to DAX trading. One word, one broker. And what we want to cover now is, in fact, the question of why are employment numbers of interest, first of all, to be on the same page. Have a look here at some theory, and then look into the release of the numbers, which came in slightly better than expected, even though I'm not really, I don't think they're very strong. They are okay. But we have an uptick in terms of the unemployment rate. And again, as I already said, and Theo mentioned this, and we can also have a look at WTI prices and inflation in this regard. So within our Trading Spotlight series here, we covered inflation several times, and also in the recent past. And I'm not sure, but I can imagine. I have to review the recordings in the YouTube channel from Admirals, but I think we made this a topic that oil prices are potentially headed higher from where we traded, pushing already most recently to new yearly highs. And the thing is that we know that inflation came down with the drop in energy prices, especially, and oil prices. And now numbers pick up again, and potentially we bottomed out now, and we hold above 3%. This is interesting because now you can see if I'm not saying the employment situation or the overall US economy is cooling down, but to some extent, again, the numbers are not that strong. And this points to some kind of like a weaker probably expected outlook, which makes a more dovish stance from the US Central Bank likelier, which means you're now running into trouble. Yeah, probably that's a good way to put it. You have inflation potentially picking up again due to rising energy prices, oil prices, so on and so forth, while the economy is cooling down. So you're running into a potential stagflationary environment. And this is an environment which is, well, positive for gold, one thing, but it's not that bullish, for example, for equities, because you have a chance of seeing higher rates for longer. Something which we mentioned already last week with Jackson Powell with Jay Powell in Jackson Hole on his speech there. So long thing short, as you can see, employment numbers are of interest right now, but you should see them within a bigger picture, and this is exactly what we want to paint here today after the numbers were released, and probably formulate then an idea on how to trade this. So first of all, some theory. So why are employment numbers of interest? So first of all, we make a very simple chain and a rough overview here, but so that we are all on the same page. So if you have strong confidence in the economy and also in the overall political situation, well, you usually see an increasing increasing orders in factories. So factories usually, well, we are focusing here, by the way, on the manufacturing side. So we are not focusing on services. We could also do it that way, but we want to focus on manufacturing, since I think this is a more intuitive way to give an idea about this. So usually what you have is confidence in politics, confidence in the overall economy. You have a positive outlook for the future, and you see that orders will increase when it comes to factories. There will more goods be manufactured because there's an increased demand. For example, I don't know, building a house or something like that. So on and so forth. So what you will see naturally is that there is an increase in industrial production, and there's usually higher demand then. So higher demand through more investments, or more customers buying these goods which are manufactured, that naturally results in factories or companies hiring more workers, because to produce more goods, you need more working hands. That makes sense. And the thing is that the stronger the demand here and the more goods need to be produced, the stronger the demand for good workers, because you want high quality goods being produced so that people don't go to a competitor, which fulfills the needs, which means to have the best people in your company producing the goods, you have to pay attractive salaries. If you don't pay attractive salaries, well, the workers go to another company, and you're losing business, thus money, and potentially going out of business if everything falls apart. So workers want to be compensated accordingly, which means you have an increase in terms of average hourly wages, average hourly earnings. That's also a number we will see covered. And what does it mean? It's not just that there's more people being hired, respectively a drop in terms of the unemployment rate, but you have also more people who have good incomes, respectively, who have more money. And the more money people have, well, what's the natural result? Well, people go and consume. So they buy stuff, they buy goods. And that means there's a higher propensity to consume, which means there's more goods to be produced, more factories, and more money being spent to build factories to produce more goods. And so there's a positive, it's a positive reinforcement loop, if you want. And that is directly impacting the overall economic growth and outlook for the underlying economy in this regard, which also means the higher the income of the people is, and the more goods are produced, respectively, the stronger the demand. Well, to increase the overall profitability of your company, you can easily hike prices. So you can say, well, you know what? It's not $1 anymore, but it's 150. Well, 50% in price increase. Well, however, so but you see, you see price hikes, which means, so now we are coming to another very important number: consumer prices. Prices is directly related to inflation. So if you hike prices for the consumer, that means that inflation is rising, which means the central bank is motivated then to raise interest rates to avoid an overheating of the economy, which naturally slows down the economic growth, or the growth cycle in this regard, cools it down to some extent, and also making money more expensive, which makes it more unlikely, or unlikelier, let's say, that a company will take out loans to invest in terms of like building a new factory and so on and so forth. So long thing short, this is the classic cycle, let's say. The problem right now is that, especially here, when we look at this letter bullet point, rising inflation, the recent push higher in inflation, especially over the course of the year 2021, end of 2021, and then over the course of the year 2022. In fact, it already started to pick up massively over the course of 2021. When it comes to producer prices, for example, well, it wasn't driven because people wanted to consume more, or, well, let's say, certainly they wanted to. Well, we were locked down in 2020 around the COVID pandemic, and governments around the globe thought it would be a good idea to lock people in their homes, respectively, shut down the economy, and interrupting supply chains. This way, not producing enough goods, while then telling the central banks, well, print more money, which we hand out to people to stay at home, in this case, as kind of like a little present for people to obeying to the government. Let's put it that way. And then, well, the people had more money, and they wanted to spend. They wanted to spend their money. So especially online in this regard, especially Amazon, for example, saw a massive inflow in terms of people buying goods very easily, and roughly speaking, and that meant that this money, which was created out of nothing, was chasing fewer goods because there was this interruption of the supply chains, which means that prices naturally rose, and still rising, respectively, that there's still not enough goods meeting the massive money supply, which we saw, this massive inflow of money. So it wasn't that there were more goods being produced and more people were hired, and you had a battle for the best workers and paying them accordingly. You also get to see this right now, but this is especially in Germany, for example. There's what's the wording for this, by the way? Let me just check this out. So the German word is Gewerkschaft. So, but I'm not really sure what it is in English. Let me just see. Gewerkschaft. What is it? Trade union? Yeah, probably labor union. So they are demanding higher wages for their people, and so long thing short, this is now where we stand. The problem is, looking at this from a German perspective, let's say. So I'm located in Berlin, in Germany, and right now companies struggling. They are heavily struggling to be profitable due to rising energy prices, because these sanctions against Russia are working so well. Finally, they admit that probably that wasn't such a good idea. It's not that someone could have seen that coming, and that's also true in other regards, like vaccines and that stuff. But the thing is, now you have companies which are struggling to stay profitable, while the workers demand higher wages, which means that these companies are starting to run into trouble, potentially running into insolvency, bankruptcy, going out of business, which means lesser goods being produced, and thus we are within a potential vicious cycle. So not getting too complicated right now, or too granular, let's say. But the thing is that right now we're in an environment which is difficult, let's call it. Okay, so the thing is, coming back now to the employment numbers, why they are of interest. Well, usually you say the stronger these numbers are, the more people are hired. Usually this is a positive sign for the underlying economy in this regard. That's the thinking process. While we have right now an environment in which we see inflation rising, you want to see still people being employed, because this means that companies are not running into high trouble right now, running into trouble because there's no more cheap liquidity as it was, let's say, 5 years ago, with the central banks keeping rates at nearly zero and buying bonds within their quantitative easing and so on and so forth. The thing is that right now, if companies continue to hire people and the economy continues to grow, let's say at least to hold stable, let's say, the central bank can potentially continue to hike rates, respectively keep rates elevated or higher for a longer period of time to fight the raging inflation. Once you see now that the overall employment situation worsens, well, what you get is fears that the Fed has to cut rates rather sooner than later because of, well, obviously these this too restrictive monetary policy path here having a negative impact on the overall economic situation, while inflation is still quite high and elevated. So you see that we are potentially running into a scenario where there's a cool down in inflation. A cool down in the overall economic situation while inflation is still very, very high. And so right now, you see that employment numbers, and that's where this wording comes from. Good news is bad news and vice versa. So good news for equities is that employment numbers worsen. The same is also true for gold, for example, because it makes it likelier that the central bank will cut rates rather sooner or later, which is usually positive for equities, but also probably especially when it comes to gold, especially. And so long thing short, this is now a chart which I screenshotted shortly after the numbers were released several minutes ago, and non-farm payrolls. So this is the so-called Fed Watch tool, and I'm looking here into June 2024. So that means there was a saying kind of 2 weeks ago, so I'm not really sure when I came across this, but that Goldman Sachs said they expect the Fed to cut rates from the second half, from middle of 2024, so which is June. And this is exactly what the market is now expecting. As you can see here, let me just wait. I just wanna test something. Let me just see. Does it work? That's it's not that. No, it doesn't work. Well, because it's December. That's after I changed this chart here, so you can see that to some, well, probably we can also look at this here. So that was the Fed Watch tool 1 month ago, and you can see here for December, the market was expecting with a likelihood of nearly 60% that at the end of the year in December that the Fed will have rates at 525 to 550. So you probably remember that was, let me just think about this. We saw a rate hike. I just have to think about this. Was it July when we saw the last 25 basis points? I think so. Did we change this chart then? Because then it makes, I'm not really sure, to be honest. I don't really know anymore. Well, we are right there. Well, it has to, yeah, certainly has to, because right now we are at 525 to 550. But obviously I didn't change the chart then. So that's a little older chart, but there was at least there was some expectation that the Fed, after having hiked rates, won't cut it into the end of the year, respectively, that we probably get to see, with a likelihood of another 40%, another 25 basis point rate hike. Let me just, oh, by the way, yeah, fair enough. Let us now just jump over to the Fed Watch tool before we jump here into the non-farm payrolls release and the price action, and have a look here at December right now. And there you can see that this number, which I just presented to you, obviously dropped to below 30%. Or close to, well, slightly above 30.6. That means that the market is now expecting, with 70%, that the Fed can't hike rates anymore, or won't hike rates anymore. Can certainly, but won't hike anymore. And in June next year, you can see that we are here expecting 50 basis points lower than the current level, with an increased likelihood of over 60%. So what means the Fed is expected to cut rates probably not into the end of the year, but then in the first half of the year already. So with potentially 25 basis points in March. Running these numbers here, you can see 50% is 50-50 that it will cut. And if the Fed does not cut 25 basis points in March already, well, then you can see that we're expected to be lower 50 basis points here from the current rate in June, which means we are expecting a first rate cut then from May onwards. So you have to play around with these numbers a little to not getting confused. I could imagine that if you watching this tool here the first time now, you're probably getting a little irritated, but we won't get too deep into this matter now. But what I wanna focus on is here, first of all, the numbers, which came in slightly better than expected, but it's the price action which shows us how the market is reacting to the numbers. And as you can see, this is the tweet from my end. You can follow me on at Jens Klatt FX, by the way, if you want. And I usually don't tweet that much, but I tweet the key events, let's say, of the week in this regard, to have them then available to an audience, which I'm using here in the charts. And as you can see, non-farm payrolls came in 187, slightly better than expected. 170 was the expectation. Unemployment rate came in 3.8%, above, significantly above what the market expected, 3.5. Now, there's obviously more people unemployed than it was expected, which is usually a bad sign, because obviously the economy is cooling down. So this is the rough thinking behind this. And you can also see that average hourly earnings here right now are not aggressively pushing higher. We're expected at 0.3 on a month-to-month basis, came in at 0.2, which means if you're saying, well, higher wages means overheating of the economy, higher inflation, well, obviously dropping. Lower wages on average means potentially the Fed has some room to cut rates. And this is usually positive for equities, respectively. This is usually positive for gold, for example. And this is exactly the reaction we are getting right now. First of all, it's potentially positive for the economy. Why WTI in this regard is pushing to new yearly highs, I would say. So let's have a look here at a 5-minute chart. They can clearly see that there was an immediate drive higher of $1 per barrel here after the numbers were released at 2:30 German time, so 1:30 UK, if I'm not mistaken. But our focus, or my focus mainly, is here on gold, and this is exactly what I think is likely to happen. So usually we would say, hey, this is a bullish environment for gold. It's a bullish environment for equities. Like, for example, the NASDAQ, let's, by the way, see. So right now Wall Street comes in. Let's see, probably we are pushing higher. So right now you can see immediate push higher. We are looking at the NASDAQ on a 5-minute time frame here. And now Wall Street comes in. So the spot market comes in. But you see, after that, well, we are consolidating right now. I think the question will be, let's just wait 10, 15 minutes, price discovery, and then whether we can paint a clearer picture. But the thing is that right now, again, roughly speaking, you would say equities more likely to be bullish because the Fed is likelier to cut rates. Gold bullish because the Fed is likelier to cut rates. USD under pressure. So EURUSD, for example, you expect to trade higher as it does right now. But the problem is that right now in the environment we find ourselves, so trading day speaking, let's say, it's not a very favorable environment for strong moves, either on the up, respectively on the downside. And the reason for that is, let's go back here. Let's go to the website, admiralmarkets.com. So you have the companies tab about Admiral Markets, and there you have the company news. And if you click on company news, you can see trading hours schedule September 2023. You click on 2023 trading schedule for September, and then you will see Monday, metals obviously close earlier. Brent, WTI, crude oil closing earlier. You can see Dow Jones closing earlier. You can see, by the way, that the DAX is not affected. This is important because it's not it's how can I say that? It's a Labor Day, so it's a bank holiday in the US. Affected to some extent. Let's say close at 22. I think it usually closes at 12 EET, if I'm not mistaken. However, so you can see shortened trading hours, Dow Jones, shortened trading hours, NASDAQ. You can see scrolling even lower than that here, stock, ETF, CFDs, US, completely closed, no trading taking place. And now the thing is, why? Why is that? Well, again, it's Labor Day. It's a bank holiday, prolongated weekend. So, and now things start to make sense because into the weekend, I don't really expect strong moves in general, and probably especially in the current environment. Now you might say, but non-farm payrolls were released, and then, well, yes, this is true, but we already saw, in my personal opinion, a quite strong move in gold, but also in equities. Let's start probably with equities, and look here again at a 5-minute chart, and there you can see that already. Very choppy action, no clear drive higher or lower based on the news. We are 5 minutes into the trading day. Well, it's probably still too early, but I think this is already telling that this is not going to move strongly in one or the other direction. But let's have a look here at what happened on Tuesday. It was this strong move higher. I think there were signs that we are potentially about to see a stronger day on the upside. We won't dig too deep into this right now, but the thing is, not really sure. Shall we? Probably it's better to work with the S&P. Probably it's better to work with the S&P. Let's go to a 30-minute chart, and let me just take this out here. Scroll that way. So you probably recall that day. That was the inflation release on the 10th of August. There was a high, which was marked, and then we sold off sharply. Numbers came in below expectation, but slightly above the pre-market. So also probably something which you would interpret as bullish. And then we just spiked higher and sold off. And from there, we continuously held lower for the upcoming 2 weeks. And that was a sign that the market is, after a very strong start into the year, is probably now about to correct at least some of its moves it has seen till May, I would say here. So that was around the starting point. And then, well, we ran already strongly higher. We saw already a drop into the start of the month. And then when we couldn't close higher on the inflation data, well, that was potentially a sign that we are now heading lower, which we saw, and then which happened. But the thing is, I consider this level here, the highs, to be relevant. Oh, I'm sorry. Let's go to the 30-minute chart. I consider this level to be relevant. And as you can see, now we are coming here lower, and then there was a strong move on Tuesday, and we are heading already into this line of resistance, quite extended, let's say. It wasn't just Tuesday, it was already 1 week earlier with Jackson Hole. We are heading into these region of interest, potentially region of interest. And then I say, well, from a risk reward perspective, I don't think that long is now very attractive. This is my first thinking. And then I also say, well, and beside of that, we have this prolonged weekend with Labor Day. And I don't really see, even, and it doesn't really matter how non-farm payrolls come in, it doesn't really matter. But I don't see, even if we spike higher or lower in whatever direction, that we are really getting to see kind of, let's say, a sustainable move. Due to this observation, coming in strong Tuesday, following through with some further spikes on the upside on Wednesday, but then, well, now looking into this longer bank holiday weekend, let's say. And that's the reason why I would say, while I think the point is clearly there, that we could say, okay, numbers come in pointing to kind of a cooler overall economic situation. So again, numbers come in better than expected, but not as strong as we used to get to see them. And in addition to that, also with a revision on the downside after quite mixed employment numbers the last month, for example. And so the thing now is that I say, well, the reaction overall, you see this small spike higher on weaker data, weaker probably based on the unemployment numbers, because you say makes a more dovish stance from the Fed likelier. This is positive for equities, and that's why we push higher. But there's no sustainability in the move itself. So we spike higher, potential stop fishing, and then we drop respectively. We are now potentially seeing kind of like whip down or chop down, and then we come back, and then we just chop out of the trading week. And that's right now why I'd be, let's say, kind of very careful to get involved. But I have a potential action level on the upside for the next week. So, and this is here, the region of the highs now. I say, well, around 4,540 in terms of the S&P, for example. Or when it comes to the NASDAQ, we can do the exact same thing. Also here, coming in now. So potential action level for next week is 15,620, 630. If we take out this level, I think then we have a good chance to push higher after the most recent run, and potentially are headed for retest of the region 15,800, probably 15,900 in terms of the NASDAQ. But again, I don't expect this move to happen today. Plus, I don't expect especially a serious attempt to break higher today, given the overall difficult picture with Labor Day and market potentially heading into the weekend, let's say. Probably that's a fair way to put it. So that's it for equity indices. What is it for gold? Same picture, in fact. So I'm not surprised to see what we get to see. And that was, in fact, exactly what I told the client in the morning. I told him, well, let's see, somehow it makes the impression on me after the recent run higher. And after we took out here the highs from the speech from Powell and Jackson Hole, that makes a strong impression on me. I think we are done on the downside. I think we are now more likely to see within the next weeks to months another attempt to break above 1,985, probably even heading higher from there. Potentially, I'm heading for new all-time highs. But I don't see a sustainable move now based on the non-farm payrolls, and I'd be very, very careful in terms of trading a break higher above 1,948 here around, and with a buy stop or something, because I could imagine that there's potentially a push higher after the most recent run, and then we are dropping back into the range and not holding that level. Well, it could certainly hold, and probably we push higher, hold the level, and then we turn higher. But to me, given my thought process, I was like, well, this is most likely not to happen, not today. Probably will happen next week if we can hold now the lows from the morning around 1,938. But this is exactly what we get to see now. So there's this spike higher. We're drifting into this potential area of interest and resistance. We see a number which is kind of, well, not sure if it's disappointing, but at least it results in market participants speculating that the Fed won't stay higher for longer in terms of rates, which means it's bullish for gold in this context, pushing higher, but we can hold higher, at least not for now, which is not a bullish sign. You want to see a breakthrough and then a hold. This is what you get to see, or want you to see. So that was a number. Let me probably head here to the, no, that's wrong. Analytics, Forex Calendar, and then go to the start of the week. That was Monday, 28th, and then United States. Let's go here, apply filter, and there you can see. Can you see something? It's not even in here. So there was, I'm sorry. It was Tuesday. It wasn't Monday. It was Tuesday. That was the number which was released here. There was also the jolts, which were published that day. By the way, I didn't know that. I didn't know that. I didn't have this on my radar. There's also the consumer confidence. Both numbers came in significantly weaker than expected. Central bank consumer confidence dropping, and also the jolts in this regard, which means jobs vacancies in this regard. So if a company or companies in general look into a prosperous future and are very optimistic about the overall economic growth, well, what does a company do? Remember our theory here. You're optimistic, you expect orders to increase, you need more workers, right? So which means you have more jobs to be filled. If this is not happening, or we are significantly dropping here, as you can see now, over the course of, let's say, the last 6 months around, from March onwards, where we topped around 12 million, well, this is a sign that the jobs were filled, or more likely that companies are not looking for people anymore, because they say, well, we can't afford them anymore. And by the way, our books are not filled. So there's no increase in factory orders when it comes to manufacturing, to the manufacturing side. Well, which makes it likelier there's a cool down in inflation, which makes it unlikelier that the Fed continues to hike rates. So that's the reason then for this significant push higher here. And as you can see, we pushed and we held this break higher, obviously. And then we continued higher, also with the ADP, probably also the GDP data on Wednesday. That's not what we get to see here. So you see an immediate push and hold higher. This is a 30-minute shot in this regard. And here you can see push higher, rejected. That's not strong. That's not follow through action. That's, well, I'm not saying we can't continue higher, but it's somehow unlikely that this will happen today. And that's why I'm staying a little behind the scenes today, and wanted to have an environment in which this is more likely to happen, which I think is the case next week from Tuesday onwards. And also here, I mentioned this, the highs in the NASDAQ, the highs in the S&P. It's also true for gold. Going long means I want to see a break above the NFP extension highs, let's call them. So if we break above 1,953, then I'm getting interested. But I want to see an environment from next week onwards, on Tuesday and following that day, that we get to see that. That would convince me a little more, let's say, than looking too optimistic, or no, looking right now at the price action. I'm not really convinced that today we will get to see kind of sustainable moves. And consider this more kind of a fake out, and more like that the market is, yeah, well, drifting out of the trading week, let's say. And then we get to see fresh impulses next week with the start into the trading week on Tuesday. And that's it. Yeah, that's it for today. I hope you learned something. I don't know if you agree. If you think that I'm completely wrong here, please feel free to check out the comment section below the YouTube video right now. Share your thoughts. I'd be more than happy to read them and react to them. Hopefully you have to say something nice. If you have a question, again, please ask it. Leave a thumb up here if you like what you saw. And also here, feel free to reach out to Admirals for further questions when it comes to account opening, for example, demo accounts, products being offered, and so on and so forth. Admirals is more than happy to help out here, the client support. And I wish you happy trading. Have a nice weekend. Enjoy yourself. Talk to you again next week then on Friday again. And that's it from my end. So talk to you soon. See you. Bye-bye.